Picture this. The US economy isn't just bouncing back, it's surging ahead with even more vigor than we initially thought, defying expectations and showcasing the incredible staying power of the world's biggest economic powerhouse. But here's where it gets intriguing. Could this unexpected strength be hiding some underlying tensions? Let's dive into the details and unpack what this means for everyone, from everyday consumers to policymakers. Washington. In a surprising twist, the US economy's performance during the second quarter has been revised upward once more, revealing a stronger recovery than earlier reports suggested. Economists are now pointing to continued robust momentum into the third quarter, highlighting just how resilient this massive economic engine truly is. To break it down simply for those new to these concepts, gross domestic product, GDP, serves as the most comprehensive gauge of a country's economic activity, measuring the total value of all goods and services produced within its borders over a specific period. In this case, GDP expanded at an annualized rate of 3.8% from April through June, according to the Commerce Department's latest and final estimate released on Thursday. For context, an annualized rate adjusts the quarterly growth to reflect what it would look like if sustained over a full year, making it easier to compare across different timeframes. This 3.8% figure is notably higher than the 3.3% reported in the previous estimate and far exceeds the initial 3% reading. What fueled this impressive rebound? A key driver was a decline in imports, which effectively boosted the net economic output. At the same time, American consumers kept their wallets open, continuing to spend on everything from groceries and gadgets to vacations and home improvements. This sustained consumer confidence helped counteract an earlier slowdown at the start of the year, when businesses ramped up inventory purchases in anticipation of trade disruptions. And this is the part most people miss. These disruptions stemmed from tariffs imposed under President Donald Trump's administration, which temporarily dragged down GDP by increasing costs for imported goods and prompting companies to stockpile ahead of time. Looking ahead, the Federal Reserve Bank of Atlanta's projections suggest that this strong growth didn't fizzle out. Instead, GDP likely maintained a healthy pace through the third quarter. For example, think of how ongoing consumer spending on durable goods like cars or electronics could be keeping the momentum alive, even as global trade tensions simmer. The government's preliminary estimate for third quarter GDP is set to be unveiled next month, so stay tuned for more updates. But here's where it gets controversial. While some experts hail the tariffs as a strategic move to protect American jobs and negotiate better trade deals, others argue they unnecessarily inflated prices for consumers and strained international relations. Could this revised GDP growth be masking short-term pain for long-term gain? Or is it just a temporary blip in a larger economic saga? What do you think? Do tariffs ultimately strengthen the economy? Or do they create more problems than they solve? We'd love to hear your take in the comments below. Share your opinions and let's spark a discussion on the true impact of these policies. This story is developing and will be updated.